Oh, it says, oh, now we're live. Let's do it.
We are live.
Well, it's been a while since we had a thing like this, Amar.
Yeah, it's been a while.
People have been begging, saying, "Where's Amar and Josh?" You deliver what
there's zero people here, so I don't know how many people were begging, but now we got some people. You know, the reality is that we get busy during this time of year. End of the year planning and beginning of the year. People want to look at our outlook and review our what they did last year.
Yep.
And so I just got busy. It's my fault.
Yeah. How dare you?
Yeah. But I think going forward, Josh, we're going to do this maybe once a month or something like that. Just like maybe slow down the cadence a little or something like that.
Once every 2 weeks is just starting to drain me, to be honest with you, because I do live streams on every Saturday on my YouTube channel. Then I do live stream every Wednesday on my local channel. I was like, another live stream. So, yeah. Hey, we got James W., Brian Fly Fisherman Dish in the house. What's up, everybody? Hey, James W. All right, cool. Not familiar with him, but certainly Brian Fly Fisherman in El Casa. Anyway, so do your disclosures, Amar, before the SEC has a fit.
Let's get right into those lovely disclosures.
Yes, sir.
Does that work? There we go.
Yep. Totes.
Actually, let's do it like this, so it's loud and clear. So here's our disclosures. Just want to make sure that everybody understands that we're not taking your specific account or situation into account. Brian, you're right. It's sunny out here.
Josh, it's sunny here too, but it's like 20 degrees.
Yeah. I don't know. I just get cold. It's because I went swimming and the water is cold still here. But all right, I digress. Going back to this, we haven't taken your specific accounts into account. This is strictly educational purposes. And there's one more. Oh, we haven't entered in a client agreement. So there's not specific advice to you, so to speak.
Yep, I'm saying.
All right. So today we're talking about passive versus active investing. Which strategy is best for you? And these strategies offer a lot of good things for people, and so let's start with some fundamental truths that we have to go over here. Is that number one? Nobody can predict the market. I got this magic 8-ball here, Josh. I don't know if you can see it, but it tells me every move the market's going to do, and that's how we make investment decisions.
I just use my tarot cards or whatever those things are called.
Yeah. And so when we hear active investments, they're like, oh, they're just trying to, you probably get sold that they can predict the future or what. Nobody can predict the future. What we are doing with active investments, though, is using probabilities to see what could be potential outcomes. And then we allocate assets based off of those probabilities, right? So just want to make sure I highlight that. I'm going to skip number 2 here. There is forced buying and selling from dealers. This is a big piece of the markets now. In fact, options make up about 150 to 200% of daily trading volume. So think of like hedge funds, banks using margin, using leverage, if you will. They create artificial flows in the market that create support and resistance levels, especially with this new type of solution that's come out, which is 0 DTE, so 0 days to expiration. So somebody can buy an option today and have it expire today.
Are you serious?
Yeah. Oh, and we see it all the time. We can see $1 million flows. You can see some of that.
I never heard that. That's crazy.
If we have time today, I can bring up some of the systems that we look at that we can
actually. Let's talk about that. Let's do that next time. I'd like to. That's pretty interesting. I didn't even know that existed.
It will take some time, so we can do a deeper dive into that.
Absolutely.
And then the last point here is that the Fed is the largest entity that drives liquidity in the market. they print dollars, so the dollars go in the market, and that creates supply and demand imbalances or liquidity premiums for assets. So that's something to kind of understand. So this idea that there's passive and active, right? The idea is the market needs both of those type of investors. Passive investors draw down the cost of investing, right? So ETFs, they're simple, they're low cost, they have provided historically strong returns over long periods of time. It's actually ideal for people that are accumulating wealth because you're able to dollar cost average in and have a very low cost drag, if you will, on your investments. Active investors are definitely needed because you need price discovery in these securities, right? If everybody did ETFs, then everybody would be buying like Amazon, Target, Walmart, but nobody would say how much is Amazon, Target, Walmart really worth, right? And so active investors create an ability to get accurate pricing in the environment, right? The other thing is that ETFs like BlackRock, for example, their ETFs, they're like one of the largest shareholders in some of these Magnificent Seven companies.
Right.
When the Magnificent Seven have a proxy vote or anything like that, BlackRock is sending it to the end investor, right? So you have a bunch of uninformed people that are making proxy decisions that are not actively engaged, right? And so those active investors really help for that. The other thing that I would like to highlight is that when you're in the retirement phase of life, or if let's just say withdrawal phase of life, right? So we have the accumulation phase where we talked about passive investing is optimal due to market efficiencies and low costs. The passive phase, or not passive phase, the distribution phase, where your goals are to manage withdrawals, minimize risk, and preserve your wealth. You got to manage sequence return risk, and you got to measure volatility, and you have to measure the need for increasing income and to protect against downturns. That is better suited with an active strategy. And in an active strategy, you most likely will have a 2-bucket strategy at minimum, where you have some low risk investments and some risky investments, right? And that approach is what we're going to talk about today. And specifically, what we're going to talk about is the active investments that we make at Client First Capital, right? So we are an asset management firm. We manage 2 portfolios. We manage the Client CFC 1 portfolio, which is a dynamic risk model where you give us the ability to increase and decrease your risk on this one portfolio. And then we have another portfolio that is consistently low risk, right? So we have a low risk investment model that you consistently have those funds available. Now it's important to have both of these because our goal is to preserve, protect, and compound in the one portfolio. We use a math-based approach, and typically we're better suited to manage risk exposure in different environments, especially drawdowns. But nobody can predict the future, right? And so we have this example here. So if you went to like Fidelity, Vanguard, Schwab, whatever, and you have an asset allocation model, they use modern portfolio theory. And modern portfolio theory, they just set it at a certain risk tolerance. So let's say most people will get a 60-40 model, and they set it at 60 miles per hour, assuming that's your risk. And regardless if it's raining, if there's hazards coming across, they keep you in that model, right? And you have to go through the drawdown, and then you come back on the upswing, right? Our solution is more like adaptive cruise control in some of the newer cars. So as we are mapping and measuring risk, if risk is going up again, then we automatically reduce your risk exposure to the markets, and we can reduce it by 50%. Now, I want to highlight two consequences or two things of this. One is that you could have risk going up and the market's going up at the same time. And when risk goes up, we're decreasing your exposure, so you may lose out on some upside of the markets.
Exactly.
The other downside, or the other thing to consider, is that And, you know, we're measuring as much risk as we can measure in the markets, but there are risks out there that you cannot measure, right? There are risks, there are environments that you can't measure. And so here, when you see these large drawdowns, I guess my drawings didn't come across here, Josh, but COVID, Lehman Brothers here, 9/11, Black Monday here. These are all events that nobody could have predicted.
Exactly.
Right? And that's why it's important to have the second portfolio be part of your strategy where you have a bucket of liquidity. You know, we're looking at a time horizon of 5 years or less, and it's predominantly short-term bonds mixed with some like 1-year structured products that we've talked about on this channel in the past. But this is what gives you the ability to outrun or not even touch those equities in your accounts until the rebound happens, right? So you can weather the storm.
Hey, Mar, let me go back to that real quick on that last. Yeah, see, because like I can't stress enough. My man John in here says that Jamie Dimon says something about something. So you know the market's inflated. People in 2000, the S&P 500 PE was about 25. All right, and then the market proceeded to have 3 consecutive years of down. In 2007, the S&P 500 PE ratio was 17. And the point being is no one knew that the markets were going to fall based on PE ratios alone. So no one was going to sit there and say the risk was too high or we had no idea. And that's the issue that going back to 9/11, we didn't know what was going to happen in 9/11. We didn't know what was going to happen in COVID. We didn't even know what's going to happen in 2007. So the idea that there's some kind of magic risk that we can all project in the future, it doesn't exist, which is the issue about an adaptive risk portfolio that says, hey, these are areas that makes us a little concerned. We might want to, I call it downshifting. I like how you call it adaptive. That's pretty good, though. I like the terminology.
Yeah, so and I agree 100% with what you're saying, is that nobody has you have to have a process.
Right. Exactly.
So active management is really for people that when the markets are changing, they don't want to have that stress of deciding what to do, right? So when you hire a manager, you're really hiring somebody that has a process. So you're hiring the process, and you have to have belief in the process is what's going to get you through on the other side of those market drawdowns, right? So a lot of people say, oh, I knew the markets were going down and I wanted to sell, but then they don't have a process to get back in, or they don't have a process to sell, right? And so that is the value that we provide as investment managers, is having a process. So I'm going to spend the next, hopefully 10 minutes or less going through our process on a very high level. We have a 5-step process. We do this process weekly. The first step in our process is to understand the economic environment. We do it through the lens of growth and inflation. So we're trying to map the rate of change on this curve. Do you see my cursor? Does my cursor come on this?
No, I'm not seeing it.
Okay. Rats. Well, I wish I could draw on this so I could, look what I
was saying cursor.
No, sorry. I thought I could draw, but I guess I can't draw.
32 degrees here, Amar, 32.
Yeah, I mean, truth is I have a t-shirt on, but we're doing this YouTube thing, so I was like, I got to put something, a little bit more respectable than Joshy over there. But anyways, so we're mapping the rate of change of growth and inflation. So we use GDP and CPI, and then you get these quadrants, right, where CPI is going up, inflation is going up, and so is growth, right? And then you get a quadrant that we're probably in right now where growth is declining, potentially declining, and inflation is going up, right? And so we map the rate of change. Actually, we don't map it. We pay a lot of money to a research company to map it for us. And they come up with slides like this to show where we are in this environment, right? So you can see on the top right-hand side, it says real GDP year over year. That looks to be somewhat stable, slightly decreasing. And then if you look at headline CPI year over year, you can see that we're not going back down to 2% is what the Fed is saying. That's clearly not happening. We're moving closer to 3.3 or higher, right? So now we have an idea of the economic environment. We can backtest assets that have done. You can backtest all assets to find out what has done well in this environment, right? And so here is traditionally what has done well and what has not done well, right? In these type of environments. When we backtest these asset classes, we want to make sure that they're still doing well today, right? Because the market does not equal the economy, and the economy does not equal the market. And so how I like to tell or explain this is that imagine you're walking Josh's puppy over there on a very long leash on a trail. Let's say it's not a fire road, but like a curvy, windy trail. That's the economy. You are the economy. You're staying in the middle of the path and you're continuing to walk. The puppy, on the other hand, or Pablo, is going all over the place, right? You have this really long leash. That's the market. And so sometimes, or I would say oftentimes, there is a disconnect between the market and the economy. The economy is the gravity of where we're heading, but the market can be all over the place. So understanding what asset classes have traditionally done well and what are actually doing well right now is very important. The next step is to understand institutional flows. So like I said earlier, options trading or market makers represent about 150% of the daily trading volume. So they create,
That's great.
They create support levels and resistance levels for certain asset classes. And that is very important to understand because that tells you the structure of the market. We use volume price analysis to kind of show where asset classes are. I would like to just quickly share my screen. Oh boy, how do we do this, Josh? It doesn't allow me to share multiple things. So
the internet's on the computer nowadays.
Oh boy.
Yeah, I've never quite figured out how to share multiple screens on StreamYard.
Oh, here we go. I figured it out. Slide your computer.
Just don't show us what you've been looking at behind your wife's back, if you know what I'm saying. What are you writing? Hey.
Entire screen.
There's nothing out there. Hey.
All right.
There
I
you
know
go.
this is a busy slide, right? But I just want to show, and we're not going to go into this in too much detail, but I want to show you what we're looking at from price volume analysis, right? So we know how much upside capture is potential, how much downside capture is potential. What's happening in the price? What's happening to our signal? Like, are we having a strong signal or are we having a weak signal? And you can see the S&P 500 for the last year has been extremely strong. You know, there hasn't been much periods of weakness, right? So there's more to go into this than just, throwing darts at the wall, I guess, is kind of what I'm trying to get at here. Oh, man, this thing takes us all the way back to the very beginning. So, remember, so we repeat this process, but remember, we can't predict everything. There's, certain things that we're not mapping the risk of, like COVID and like, 9/11 or Lehman Brothers collapse. That's not part of our anybody's process in terms of identifying those. And so you need to make sure that you have some liquidity. And this defined outcomes portfolio is really what creates highly liquid securities that make sure that you have a safe place to access liquidity and that you're keeping up with inflation. And so the combination of these two is how we kind of tailor it to our clients, and we can customize it and tailor it for everybody. So let's look at what happened in 2024. So if you're doing traditional asset allocation, you're looking at equities and fixed income. Those are the only two things that you're pretty much invested in. If you look at equities, the S&P did 25.02% last year.
Mm-hmm.
Really, a great year for large cap. But if you peel back the layers of the S&P 500, you'll find 7 companies, the Magnificent Seven, was a large part of this return. And so another way to look at this is if you took those 493 other companies and you put $1 in each one of those companies, equally weighted, your return for the year would have been 8%.
Yeah.
So over 65% of the S&P's return came for those 7 companies. International was up about 4%. U.S. bonds, 1.25. Muni bonds, 1.05. So bonds really didn't do much last year. When we look at alternatives, commodities, in the back half of the year, we're going up. Precious metals, for example, gold last year was up 27%. It outpaced the S&P 500, right? So that's kind of interesting to see. So if you're like in a asset allocation model, there's almost no exposure to precious metals, right? And so that's something. Currencies, U.S. dollar, back half the year did really well.
Yeah.
The
dollar's collapsing. The dollar's collapsing. We keep hearing.
Yeah, it's up 14%.
Exactly. That's collapsing.
Year. Yeah. This slide, I like to highlight just 2 things here. When the U.S. economy is doing well, like 2023, 2024, fixed income has been a drag on your portfolio. So if you had a 60-40 portfolio, you own one of the best asset classes and one of the worst. So diversification, fixed income was a drag on your investments. In 2022, when large caps were down 18%, correlations between equities and fixed income goes to 1. And I can't repeat this enough. It's happened multiple times. When there's risk in the markets, risk assets the correlation between them go to 1. What that means is that large cap was down 18%. Fixed income was also down. They're going in the same direction. It's not giving you that protection that you need. It was down 13%.
Yep.
And so we believe our solution is better to preserve clients' investments against inflation, protect on large downswings.
During major market corrections, the correlation always reverts to 1. You know what I'm saying, Amar? It always happens, man.
And then compound your growth over a longer period of time. So I'm sure, we're going to open this up to questions here in a sec. But I'm sure one question, well, Amar, how did you guys do?
Right.
Well, so in 2024, our equivalent model, to 60-40, we had roughly 25 clients in there. And if I take all those 25 clients and I average it out, net of fees, those clients were up 16.5%. And the BlackRock asset allocation model was up 13.3% during that same time. So, I don't know what we're going to do in the future. I don't know what's going on, going to happen, in years to come. But we have a process, and I want to highlight this over and over again. And our process is to help you protect against the downside, help you grow your investments over the long run. And, we are outperforming. We are doing better than traditional asset allocation. So,
and no one would ever, and guys, no one's ever going to sit there, and Amar would totally agree with this. No one's ever going to say, oh, we can outperform in the future, but the facts are the facts.
Yeah.
Taking the risk, your risk-adjusted return, Amar, when you factor in the risk you took, not only did his net returns beat the markets, but his risk-adjusted, he took less risk than the market.
That's great. I forgot to highlight that part, Josh, is that we had over 80 days with 30% in cash in our variable portfolio. Right? The variable risk. And if you pair that with the defined outcomes, you could have as much as 40 to 50% in low risk assets in 2024. But let's answer some questions. I know we got a hard stop here, so we got about 4 minutes. I'm going through the comments. I'm going to start at the top. I'm going to start with this because, Brian, you're right. I am hot, so I'm going to take this off. I have a T-shirt on. This is not a...
Is it right side out or outside in? Or right?
It is hot here. All right, let's go through some questions. James, market's inflated. When we look at momentum indicators, that would be it would not say that, right? So there's still momentum and so let's maybe talk about this a little bit deeper. Is that when we had DeepSeek? Do you guys remember the DeepSeek flash crash in NVIDIA or whatever you want to call the AI space? That did have an impact to momentum, but momentum is back. You know, S&P 500 is up over 4% year to date, right? Uh, so I would not agree with Jamie Dimon based off of our process, right?
Well, they always say is that market's inflated. I mean, it's always inflated relative to 1975. The PE ratio is 8%. It's just stupid.
Right. If you're 62 and you're retired and you have no need for withdrawals for another 6 years, you should be invested. It's not really a question. It's just a statement, I guess. Adaptive cruise. What is that? My car is too old. Ha 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 ha. So this is, you know, I like that motorcycle, like Gullwing or something. But yeah, you know, that's the analogy we use. Is that if you're using Fidelity, Vanguard, Schwab, you're using cruise control from old 2000s like Michael, right? You got to use something like the new technologies that automatically slow down when there's risk ahead. Josh, I'm just going to stop for a second and say, if you like our content,
yes,
get off of Josh's channel, go on our channel, like, subscribe. It helps the YouTube algorithm gods to find our channels and our content. Our channel is Client First Cap Learning, and we have also a website, which is clientfirstcap.com. I'll put it in the comments.
And he does other interviews with live streams and stuff too. So it's not just, I mean, he has his own content that's unique of mine for sure.
Yeah. People will get it. Yep. I think the bigger piece here is that we have a process to get you out of the markets when risk is high and to get you back into the markets when risk starts to normalize. Yeah, I would agree with that. Also, time period. And you really saw this with Lehman Brothers, right? The Lehman Brothers kind of accelerated the drawdown there. Opinion on an annuity inside a Roth IRA. I don't know about you, Josh, but I don't like it. The only annuity that I would like is it's called an investment-only annuity. It's called IOLA. And the IOLA has an internal expense of less than 15 basis points. So depending on how big your Roth IRA is or what your purpose is, you know, the investment-only annuities can be a big part of making that happen.
That's what everyone wants to see, Amar, right there.
All right.
Yeah, a guy mowing our yard next door, and the Finney's going crazy.
All right, it's 21 out here, and I'm in a t-shirt.
Yeah, Marie says at the very bottom, because I'm gonna have to bounce here in a second. Most advisors would say just ride the wave. Glad Amar has this procedure. It's not for everybody, Marie. I mean, a lot of people, I don't know, but if you're in the retirement mode, it's important to have some kind of process, like Amar was saying, so that way, you not only do you get out, but when you get back in, I cannot tell you how many people got out at some point in 2008 and they never got back in ever. And now they're like emailing me like, when should I get back in? I said, dude, I don't know, because they have no process. And anyway. All right, I gotta go. I gotta bounce tomorrow. All right, so I'm gonna get off.
I'm gonna finish off the questions, and then I'll end it hopefully here at 30 minutes. So
all right, see you guys. Thanks for being here. God bless.
Yeah, so I can do this. So I just want to make sure that people know that we are not double verified performance, or we're not GIPS compliant or anything like that. But we can show you our portfolios and what they've done over a period of time. Just reach out to us. I can show you some allocations. Boy, I don't know how to do that on the live stream because I have to open up programs and share screens here and hide some details. But Maybe in a future call, maybe we can do this on a quarterly basis, make it focus on investments. Yeah, I've been coaching basketball, women's basketball. My girls, 7 and 9. I got gray hair, trust me. It's hurting cats. I'm scrolling through. So no management fee. I don't know what that is. Yeah. Again, diversification has been shown at least from 2000s to now that because correlations move up, when risk assets and bonds, when the correlations go up, those two, diversification hasn't helped protect portfolios, right? And so oftentimes what we're looking at is the correlation over 30 days, 60 days, 90 days, and seeing the direction of those correlations and which way they're going to decide, what asset classes are actually going to protect on the downside. And so there, for example, gold has been one of the pieces that we've used. This strategy is not just for retirement. It's an investment strategy. We manage institutional money as well, and so those are nonprofits or charitable accounts that are not looking to retire, right? So they're looking to just grow assets at a conservative pace. This is true. Social Security tax trap can impact your investment return because of the extra taxes owed. The one thing I would say with this is that, when you have a model that decreases risk and you're in a taxable account, that can create some taxable gains, and that may impact your Social Security, like Sergio is mentioning here. So why not just buy, VO just overtook S&P 500. The reality is that a lot of people that buy it, they get to a point where they can't hold on to it because of the amount of gains or whatnot, and that stress can impact your investment decisions. I mean, I'm sure you can just buy those two and hang out, but in 08 and when we had some of these crashes in the past, keep in mind since 08 till now, right? The markets have just gone steadily up, right? So remember those bad times as well. Yeah, you don't want to just ride out the wave because the markets in the past have had let's call it like 2 to 3 years of a bear market. And so in the first year, if you're told to ride it out, the second year it gets harder to ride it out, and the third year you sell, and that's the worst possible time, right? Most advisors don't take risks. They rely on, the truth of this is, Sean, most advisors are funding asset allocation models, and there's a portfolio manager that you're not talking to that's building a model that's at scale. And so, most advisors are not portfolio managers. That's what I would say with this. This would be too much risk. One company, we can't do that as fiduciaries. I would say roughly about 20% of our clients are pre-retirees, and then 80% are retired. And that's just, I left from USAA and I had clients that I was already working with. And so that's what, those are the clients that I still work with today. I mean, BlackRock, Modern Portfolio Theory, Asset Allocation Model, 60/40 was up 13.3%. So I'm pretty sure that he's actually saying the truth. I have no clue what this is. All right. I'm going to end it here if I don't have any. Oh, actually, I didn't realize I could still scroll down here. Does receiving interest income from bond index funds that returns? I mean, when you reinvest in anything, right, you're buying back more. I would just say with bond funds, you've seen interest rates go up, bond prices have gone down, so you're buying bonds that are a lower cost. But that supply and demand could offshift, or interest rate change can offshift off the bonds. This is based off of financial planning, 100%. So for most of our clients, their assets that they're going to use during their lifetime, right? We want to identify that, and then we have a separate bucket which we didn't show today, which is like basically high risk tech. Like, I guess somebody asked about Tesla, but like high risk type investments. Sean has made several comments. I just really, the case for bonds is harder to make, but I think this is good. All right, I'm going to log off. Thank you for watching. If you like any of our content and want to get more information, subscribe to our channel, Client First Cap Learning, on YouTube there. And then you can visit our website, which I'll put in the comments right now. It's www.clientfirstcap.com. We have a newsletter, just comes out once a month with more retirement insights. Thank you for watching. Bye.